The billion-dollar paradox. What if I told you that a multi-billion-dollar trade deal, the kind of news that should send a stock to the moon, actually just triggered a market bloodbath? As the world watched President Donald Trump touch down in Beijing for the first US presidential visit in nearly a decade. On paper, the trip was a triumph. Trump stood alongside Xi Jinping and announced a massive commitment. China would order 200 Boeing aircraft. In any normal market, Boeing shareholders would be popping champagne. But look at the tape. Instead of skyrocketing, Boeing just suffered its steepest single-day collapse in over 6 months. It didn't just slip, it cratered by nearly 5% instantly, wiping out billions in market cap, while the good news was still trending on social media. Why is good news tanking the market? Because behind the handshakes and the photo ops, a massive geopolitical chess match is being played out. And if you're only reading the headlines, you're the one about to get checked. Today, we're breaking down the Beijing Trap, from weaponized order books to a 113-page insider disclosure that has Wall Street's blood boiling. Segment 1. The Macro Illusion and the Boeing Breakdown. To understand the panic, you have to understand the macro illusion. In institutional investing, prices aren't moved by what happens. They're moved by what happens relative to what was expected. For months, the Trump-Beijing trade was built on the expectation of a 500-jet mega deal. That was the number needed to genuinely reset the trade deficit and signal that China was moving away from Airbus. By delivering a commitment of only 200 planes, Beijing didn't give Boeing a win, offering instead a measured diplomatic statement. Think about the math. 200 jets represents only 3% of Boeing's current backlog of 6,807 aircraft. It's a drop in the ocean. Even worse, the White House has not yet released the specific aircraft models or binding delivery timelines. Institutional algorithms saw this for what it was, a statement of intent rather than a binding contract. Beijing has effectively weaponized the industrial order book. They are dangling the possibility of 750 jets to keep the US at the negotiating table, but they are only feeding the market enough to prevent a total collapse. This macro illusion keeps retail investors buying the dip, while institutional money realizes that Boeing's growth, CAGR, is now hostage to Chinese political whims. Segment 2. The Taiwan Threat Vector. But the Boeing planes are just a distraction. The real story happened behind closed doors in the Great Hall of the People. On Thursday morning, the briefing out of Beijing took a dark, aggressive turn. President Xi Jinping issued a direct warning to Trump, mishandled the Taiwan question, and the two nations could collide or even clash, putting the entire relationship in great jeopardy. Why were the kings of Silicon Valley sitting in that room? Because they know that if the Taiwan Strait goes hot, the global economy goes into cardiac arrest. Taiwan Semiconductor produces 90% of the world's most advanced chips. If China squeezes Taiwan, they squeeze the life out of Nvidia, Apple, and AMD. Beijing is now explicitly tying technology and aviation cooperation to US compliance on Taiwan. They want Trump to reduce arms sales and change the US posture to opposing independence. The market is no longer pricing in how many chips a company sells. It's pricing in the TSMC probability of interruption. Every time Xi raises the rhetoric, your portfolio takes a geopolitical risk haircut. Segment 3. The Insider Disclosure Anomaly. Now, this next development raises the most serious questions. While retail investors were getting crushed by the Boeing drop, on May 14th, a 113-page financial disclosure was quietly released by the U.S. Office of Government Ethics. The disclosure reveals that the smart money was positioned for this summit months ago. On February 10, 2026, President Trump's managed accounts engaged in a massive rotation. They sold between $5 million and $25 million each in Amazon, Meta, and Microsoft, locking in peak valuations. But at the exact same time, those accounts opened multi-million-dollar positions in Boeing and Nvidia. Think about the timing. The relationship between policy timelines and institutional market movements remains a critical area of study. The administration states that these automated portfolios are managed independently of any policy actions. However, the proximity of these investments to major trade deals demonstrates why tracking official disclosures is an essential tool for investors seeking a deeper understanding of market trends. Segment 4, Nvidia in the crossfire. Let's look at the crown jewel of the AI revolution, Nvidia. It hit a record high of $236.54, surpassing silver to become the world's second largest asset. The rally was driven by reports that the US has cleared 10 major Chinese firms to buy the H200 AI chip. We're talking about the giants, Alibaba, Tencent, ByteDance, and JD.com, with Lenovo and Foxconn cleared as distributors. Each firm is allowed to buy up to 75,000 units. But here's the trap. The Trump administration has turned this into a state-managed revenue scheme. The US Treasury reportedly takes a 25% cut of all H200 sales to China in exchange for those licenses. And there's a catch. Not a single chip has shipped yet. Beijing is actually pressuring its own companies not to buy the H200, urging them to focus on domestic innovation like Huawei and DeepSeek. Nvidia is caught in a pincer move, taxed by Washington and blocked by Beijing. The bull case depends on these sales, but the geopolitical reality is that China is building a tech stack that doesn't include the US. Conclusion: tactical execution. So what is the tactical execution here? I am not a financial advisor, but the data is clear. The Beijing shockwave is just starting. First, stop chasing the peace deal rallies in tech. If you want safety, look at the backlog reality. Defense primes like Lockheed Martin and RTX Corporation are sitting on record backlogs, $193.6 billion for Lockheed and a massive $271 billion for RTX. These are long-duration programs that don't depend on a single summit or a handshake in Beijing. Second, watch Boeing as it actively tests the vital $220 threshold. If it fails to hold this immediate level, the macro illusion is officially dead, opening the door for a rapid slide toward the next major support floor at $187.50. The takeaway? The market is no longer about earnings, it's about geography and government disclosures. We have entered a period of managed volatility where the gap between what you see and what the smart money knows is widening. If you want to stay ahead of the insider anomalies before they hit the tape, hit that subscribe button and join the pulse at GeoVantage Markets. I'll see you on the next update.